University of Santo Tomas Taxation Law Review Pre-Week Notes of 2016 Part 3. Distinguish between allowable deductions and personal exemptions. Allowable deductions, it partakes of the nature of business expenses, while in personal exceptions, it partakes of the nature of personal, living, or family expenses. In allowable deductions, to recover or recoup the cost of doing business. In personal exemptions, to recover the personal, living, and family expenses paid or incurred during the taxable year. In allowable deductions, it may be claimed by individual and corporate taxpayers except the non-resident alien not engaged in trade or business and the non-resident foreign corporation. While in personal exemptions, they are granted only to the individual taxpayer except number 1, non-resident alien not engaged in trade or business without reciprocity clause with respect to additional exemptions only, and number 2, non-resident alien not engaged in trade or business with respect to both basic personal exemption and additional personal exemptions. Now, in the allowable deductions, the actual expenses paid or incurred in the conduct of trade, business, or profession. In personal exemptions, arbitrary amounts granted to approximate the personal expenses that may be incurred by individual taxpayer. Now, in allowable deductions, it is classified into number 1, itemized deductions, and number 2, optional standard deductions. While in personal exemptions, it is classified into number 1, basic personal exemptions, and number 2, additional personal exemptions. Now for another topic, it is the exclusions from gross income and, on the other hand, the deductions from gross income. Okay, in the exclusions from gross income, these are the incomes received or earned but are not taxable because, number 1, it is expressly exempted from income tax by the fundamental law or statute. Number 2, it is subject to another kind of internal revenue tax. Number 3, it does not come within the definition of income as when the amount received represents return of capital. I repeat, for the exclusions from gross income, incomes received or earned but are not taxable because, number 1, it is expressly exempted from income tax by the fundamental law or statute. Number 2, it is subject to another kind of internal revenue tax. Number 3, it does not come within the definition of income as when the amount received represents return of capital. Now, in deductions from gross income, it is something spent or paid in earning the income which the law allows to be deducted from gross income in order to arrive at net income. Now, for exclusions for gross income, it is necessary for the computation of gross income. Now, for the deductions from gross income, it is necessary for the computation of the net taxable income. Okay, let's go to the comparison of the exclusions, deductions, and tax credit. I repeat, the difference between exclusions, deductions, and tax credit. In exclusions, it is income received or earned but are not taxable because of exemption by virtue of a law or treaty, hence not included in the computation of gross income. While in deductions, these are deducted from the gross income to arrive at net income taxable income. On the other hand, on tax credit, it refers to taxes allowed to be credited against Philippine income tax to arrive at the tax due and payable. Now let's go to the exclusions. Exclusions is necessary for the computation of gross income, while in deductions, it is necessary for the computation of net income, taxable income. Now, in the tax credit, it is necessary for the computation of the income tax liability. Okay, for the another topic, the basic personal exemption. The basic personal exemption is 50,000 pesos irrespective of the status of the taxpayer. I repeat, for the basic personal exemption, 50,000 pesos irrespective of the status of the taxpayer. But here's an exemption. In the case of non-resident alien engaged in trade or business, personal exemptions allowed in his country to Filipino citizens not residing in such country or that allowed in the Philippines, whichever is lower. This is subject to the rule of reciprocity. Thus, if the foreign country of which the non-resident alien engage in trade or business is a subject or citizen does not allow personal exemption to non-resident Filipino citizens doing business in such country. The Philippine government will not allow such personal exemption thereto. And note also that in the case of married individuals where only one of the spouses is deriving gross income, only such spouse shall be allowed the personal exemption. I repeat, note, in the case of married individuals where only one of the spouses is deriving gross income, only such spouse shall be allowed the personal exemptions. Now for the additional personal exemption for dependents. I repeat, additional personal exemption for dependents. Okay. 25,000 for each qualified dependent, not exceeding 4 dependents. Note, the additional exemption for dependents shall be claimed by only one of the spouses in the case of married individuals. In the case of legally separated spouses, additional exemptions may be claimed only by the spouse who has custody of the child or children. I repeat that the additional exemption for dependents shall be claimed by only one of the spouse in case of married individuals. But in the case of legally separated spouses, additional exemptions may be claimed only by the spouse who has the custody of the child or children. Now for the lists of qualified dependent. Letter A, legitimate, illegitimate, or legally adopted child. Letter B, chiefly dependent upon and living with the taxpayer. Letter C, if such dependent is number 1, not more than 21 years old, number 2, unmarried, number 3, not gainfully employed, and or letter D, if such dependent is number 1, regardless of age, number 2, is incapable of self-support because of mental or physical defects. Now, note that a senior citizen is no longer considered as qualified dependent of purposes of claiming additional exemptions. Additional exemption per dependent is allowable only to individual taxpayers with a qualified dependent child or children. Now, I repeat for the qualified dependent. Letter A, legitimate, illegitimate, or legally adopted child. Letter B, chiefly dependent upon and living with a taxpayer. Letter C, if such dependent is number 1, not more than 21 years old, unmarried, not gainfully employed. And letter D, if such dependent is number 1, regardless of age, number 2, is incapable of self-support because of mental or physical defects. I repeat, note, a senior citizen is no longer considered a qualified dependent for purposes of claiming additional exemption. Additional exemption per dependent is not exceeding 4 and is allowable only to individual taxpayers with a qualified dependent child or children. Okay. Status at the end of the year rule. I repeat, status at the end of the year rule. Mar and Joy got married in 2010. A week before their marriage, Joy received, by way of donation, a condominium unit worth 750,000 pesos from her parents. After marriage, some renovation were made at cost of 150,000. The spouses were both employed in 2011 by the same company. On 30 of December 2012, their first child was born, and a second child was born on 7th of November 2013. In 2014, they sold the condominium unit and bought a new unit. Under the foregoing facts, what were the events in the life of the spouses that had income tax incidents? The answer, letter A, the events of the life of spouses, Mar and Joy, which have income tax incidents are the following. Letter A. Their marriage in 2010 qualifies them to claim personal exemption for married individuals. Letter B. The employment in 2011 by the same company will make them liable for the income tax imposed on gross compensation income. Letter C. Birth of their first child in December 2012 would give rise to an additional exemption of 25,000 for taxable year 2012. Letter D. Birth of their second child in November 2013 would likewise entitle them to claim additional exemption of 25,000 pesos arising their additional personal exemption to 50,000 for taxable year of 2013. And sale of their condominium unit in 2014 shall make the spouses liable to 6% capital gains tax on the gain presumed to have been realized from the sale. Now I repeat for the answer for the question for the under the foregoing facts, what were the events in the life of spouses that had income tax incidents? Letter A, their marriage in 2010 qualifies them to claim personal exemptions for married individuals. Letter B, their employment in 2011 by the same company will make them liable to the income tax imposed on gross compensation income. Letter C, birth of their first child in 2012 December will give rise to an additional exemption of 25,000 pesos for taxable year of 2012. Birth of their second child in 2013 would likewise entitle them to claim additional exemption of 25,000, raising their additional personal exemption to 50,000 for taxable year of 2013, and also the sale of their condominium unit in 2014 shall make the spouses liable to the 6% capital gains tax on the gain presumed to have been realized from the sale. Now for the next topic is the itemized deductions. Itemized deductions. There are A2 letter A2 letter J. Okay. Itemized deductions. Letter A, ordinary and necessary expenses. Letter B, interest expense. Letter C, taxes. Letter D, losses actually sustained during the taxable year and not compensated for by insurance or other forms of indemnity. Letter E, bad debts. Letter F, depreciation. Letter J, depletion of oil and gas wells and mines. Letter H, charitable and other contributions. Letter I, research and development. And last is the letter J, the pension trust and contributions. Now let's go to the very first itemized deductions. Letter A, the ordinary and necessary expenses. Okay, ordinary and necessary expenses. The ordinary expenses, it is any expense that is normal or usual in relation to the taxpayer's business and the surrounding circumstances. Next, necessary expenses. Necessary expenses is one which is appropriate and helpful in the development of taxpayers' business and is intended to maximize losses or to increase profits. I repeat, the ordinary expenses, it is any expense that is normal or usual in the relation of the taxpayer's business and the surrounding circumstances. Necessary expense is one which is appropriate and helpful in the development of taxpayers' business and is intended to minimize losses or to increase profits. Now for the requisites for deductibility, there are six here. Number one, the expenses must be directly attributable to the development, management, operation, and or conduct of trade or business of the taxpayer. Number two, paid or incurred during the taxable year. Number three, the expense must be substantiated by proof. Number four, the expense must be reasonable. Number five, if subject to withholding taxes, proof of payment to the BIR. Number six, expenses must not be against public policy, public moral, or law. I repeat for the requisites for deductibility. Number one, the expense must be directly attributable to the development and management, operation, and or conduct or trade or business of the taxpayer or in the exercise of taxpayer's profession. And number two, paid or incurred during the taxable year. Number three, the expense must be substantiated by proof. Number four, the expense must be reasonable. Number five, if subject to withholding taxes, proof of payment to the BIR. Number six, expenses must not be against public policy, public moral, or law. Next is the substantiation requirements. The substantiation requirements is the expenses must be supported by official receipts or adequate records showing that number one, the amounts of the expense being deducted, and number two, the direct connection or relation to the expense being deducted to the development, management, operation, and or conduct of trade, business, or profession of the taxpayer. Okay, number one, here are the salaries, wages, and other forms of compensation for personal services. Okay, salaries, wages, and other forms of compensation for personal services actually rendered, including the gross up monetary value of fringe benefit furnished or granted by the employer to the employee. The requisites for deductibility is letter A, the payment must be reasonable. Letter B, they are in fact payment for personal services rendered. Note, reasonable and true compensation is only such amount as would ordinarily be paid for services like enterprises and like circumstances. Next, requisites for the deductibility of bonuses. Okay. Here are the requisites. The payment of the bonus is made in good faith for additional compensation. Letter B, it must be for personal services actually rendered. Letter C, the bonus when added to salaries is reasonable when measured by the amount and quality of the services performed with relation to the businesses of the particular taxpayer. Next, travel expenses. Travel expenses here and abroad while away from home in the pursuit of trade, business, or profession. Or this is what we call away from home. away from the location of the employer's principal place of employment, regardless of where the family residence is maintained. Note, traveling expenses includes transportation, meals, and lodging. Next is the rentals. Rentals requisites for deductibility. Number one, payment was made as a condition to the continuous use of the or possession of the property. I repeat in number one, payment was made as a condition to the continuous use or possession of the property. Number two, taxpayer has not taken or is not taking title to the property or has no equity other than that of a lessee, user, or possessor. Number three, property must be used in trade or business. Number four, the withholding tax must have been withheld and paid. Next, the entertainment, amusement, and recreation expenses, or it is known as EAR. I repeat, entertainment, amusement, and recreation expenses. Okay. In EAR, it includes representation expenses and or depreciation or rental expense relating to entertainment facilities. Okay. These are number one of these is the representation expenses. Representation expenses, these are the expenses incurred by a taxpayer in connection with the conduct of his trade, business, or exercise of profession in entertaining, providing amusement and recreation to, or meeting with a guest or guests at a dining place, place of amusement, country club, theater, concert, play, sporting event, and similar events or places. I repeat, representation expenses. These are the expenses incurred by a taxpayer in connection with the conduct of his trade, business, or exercise of profession in entertaining, providing amusement and recreation to or meeting with a guest or guests at a dining place, place of amusement, country club, theater, concert place, sporting event, and similar events or places. Now, who are the persons or who may claim the EER? Letter A. Individuals engaged in business, including taxable estates and trusts. Letter B. Individuals engaged in practice of profession. Letter C. Domestic corporations. Letter D. Resident foreign corporations. Letter E. General professional partnership, including its members. I repeat, who may claim the EER? These are the individuals engaged in business, including taxable estates and trust. Letter B, individual engaged in practice of profession. Letter C, domestic corporations. Letter D, resident foreign corporations. Letter E, the GGP or the General Professional Partnership, including its members. Note, any expenses incurred for entertainment, amusement, or recreation that is contrary to law, morals, public policy, or public order shall in no case be allowed as deductions. Examples of these are the bribes, kickbacks, and other similar payments, which is not allowed as deductions from gross income. Now, in ceiling on the amount of EER. Number one, for taxpayers engaged in sale of goods or properties, which is 0.50% of net sales. Example of this is the gross sales less sales trust less sales returns or allowances and sales. Number two, for taxpayers engaged in sales of services, including exercise of profession and use or lease of properties, which is 1% of net revenue. Number three, for taxpayers deriving income from both sale of goods and services, and the allowable deduction shall in all cases be determined based on an apportionment formula taking into consideration the percentage of the net sales net revenue to the total net sales net revenue, but which in no case shall exceed the maximum percentage ceiling provided. Okay, these are not considered as EER. I repeat, not considered as EER. EER. Letter A, expenses treated as compensation or fringe benefit for services rendered under the employer-employee relationship. Letter B, expenses for charitable or fundraising events. Letter C, expenses for bona fide business meeting of stockholders, partners, or directors. Letter D, expenses for attending or sponsoring an employee to a business league or professional organization meeting. Letter E, expenses for events organized for promotion, marketing, and advertising. Letter F, another expenses of similar nature. Next is the repairs and maintenance. In repairs and maintenance, if it is minor repairs, it is outright expenses, which is deductible in the period such expense is incurred. If it is a major repairs, it capitalized and included in determining depreciation expense if they tend to prolong the life of the asset. Now, next is the promotional and advertising expenses. Okay, letter A, advertising to stimulate the current sale of the merchandise or use of services are deductible as business expenses provided the amount incurred is reasonable. Letter B, advertising designed to stimulate the future sale of merchandise or use of services are not deductible as expense, but must be spread over a reasonable period of time that it helps earn the income. Letter C, advertising to promote the sales or of shares of stock or to create a favorable corporate image are not deductible. Next is the cost of materials. The materials and supplies are deductible only to the amount actually consumed or used in the operation during the taxable year. Okay, next is the expenses for professional. Expenses for the professional, which is letter A, supplies expense. Letter B, expenses paid in the operation and repair of transportation equipment used in making professional calls. Letter C, membership dues to professional associations or societies and subscription to journals. Letter D, office rentals. Letter E, utilities expense for water and electricity consumed in connection with the exercise of the profession. Letter F, communication expense. Letter G, expense for hiring employees or office assistants. And letter H, expenses incurred for books, future, and professional. Okay. Next is the interest expenses. Interest expenses. This is the letter B or the number 2 of the allowable, for the itemized deductions. Itemized deductions. Okay. For the number 2 or letter B, I repeat, the very first of the category of the itemized deduction is the ordinary and necessary expenses. And the second is the interest expenses. And the third is taxes and so on. So now we are here in number 2, the interest expense. Okay, interest expense. Payment for the use or forbearance or detention of the money, regardless of the name it is called or denominated. It includes the amount paid for the borrower's use of money during the term of the loan, as well as for his detention of money after the due date for its repayment. I repeat, interest expense. These are the payment for the use or forbearance or detention of money, regardless of the name it is called or denominated. It includes the amount paid for the borrower's use of money during the term of the loan, as well as for his detention of money after the due date for its repayment. Now, requisites for deductibility of the interest expense. Okay. Number one, there must be an indebtedness. Number two, the indebtedness must be that of the taxpayer. Number three, the the interest must be legally due and stipulated in writing. Number four, the interest must be paid or incurred during the taxable year. Number five, the indebtedness must be connected with the taxpayer's trade, business, or exercise of profession. Number six, the interest arrangement must not be between related taxpayers. And number seven, the allowable deductions have been reduced by an amount equal to 33% of the interest income subject to tax. I repeat, for the requisites for deductibility, number one, there must be an indebtedness. Number two, the indebtedness must be of the taxpayer. Number three, the interest must be legally due and stipulated in writing. Number four, the interest must be paid or incurred during the taxable year. Number five, the indebtedness must be connected with the taxpayer's trade, business, or exercise of the profession. Number six, the interest arrangement must not be between related taxpayers. And number seven, the last, the allowable deductions have been reduced by the amount equal to 33% of the interest income subject to tax. Next is the limitation on the deductible interest expense. In limitation on the deductible interest expense is the taxpayer's otherwise allowable deductions for the interest expense shall be reduced by an amount equal to 33% of the interest income subject to final tax. Okay, this limitation shall apply regardless of whether or not a tax arbitrage scheme was entered into by the taxpayer or regardless of the date of the interest-bearing loan and the date when the investment was made, for as long as during the taxable year there is an interest expense incurred on one side and an interest income earned on the other side, which interest income had been subjected to the final withholding tax. Note, the rate of interest limitation is actually the difference between the normal corporate income tax and the 20% final tax as percentage of the NCIT. Rounded off, thus under the 30% NCIT is that 30% minus 20% over 30%, or is the total is 33.33%. Now for the tax arbitrage. Tax arbitrage, it is a strategy which takes advantage of the difference in tax rates or tax systems as the basis for profit. I repeat, the tax arbitrage, it is a strategy which takes advantage of the difference in tax rates or tax system as the basis for profit. Okay, in non-deductible interest expense, it is the interest paid in advance through discount or otherwise. It is such interest shall be allowed as deductions in the year the indebtedness is paid. And number two, if the indebtedness is payable in periodic amortizations, the interest which corresponds to the amount of the principal amortized or paid during the year shall be allowed as deduction in such taxable year. Now, number two for the non-deductible interest expense is interest between related taxpayers. Number three, if the indebtedness is incurred to finance petroleum exploration. I repeat, for the non-deductible interest expense is number one, interest paid in advance through discount or otherwise. Number two, interest between the related taxpayers. And number three, if the indebtedness is incurred to finance petroleum exploration. Next is the optional treatment of interest expense incurred to acquire ordinary assets. Number one, deductions. Number two, treated as capital expenditures. Now for the letter C, for the next topic of the itemized deductions, letter C is the taxes. Because I repeat, for the itemized deductions, letter A is the ordinary and necessary expense. Number 2 is the interest expense, and now this is the number 3, the taxes. Okay, taxes. Requisites for deductibility of the taxes. Number 1, payment must be for taxes. Number 2, tax must be imposed by law and payable by the taxpayer. Number 3, paid or incurred during the taxable year in the connection with taxpayer's trade, business, or profession. And taxes are not specifically included by law from being deducted from the taxpayer's gross income. Okay, next is the treatment of surcharges, interests, fines for delinquency. In treatments of surcharges, interests, fines for delinquency, these are the interest on delinquent taxes are deductible as they are considered as interest or on indebtedness and not as taxes. In the non-deductible taxes, they are the number 1, Philippine income tax. Number 2, income taxes imposed by authority of any foreign country, but with the exceptions that when the taxpayer does not signify in his return his desire to avail of the tax credit. And number 3, estate and donors tax. Number 4, special assessment, like the taxes assessed against local benefits of a kind tending to increase the local benefits of a kind tending to increase the value of the property assessed. And number 5, the VAT. And number 6 is the stock transaction tax. Now for the limitation on deductible taxes for NRA ETB, or the non-resident alien in trade, engaged in trade or business, and the RFC, which is the resident foreign corporation. It is only if and to extent that they are connected with income from sources with the Philippines. I repeat, limitation on deductible taxes for NRA, ETB, and RFC only if and to the extent that they are connected with income from sources within the Philippines. Note, no deductions are allowed for amounts representing number 1, interest, number 2, surcharges, and number 3, fines or penalties incident to delinquencies. Okay, the interest on delinquent taxes, although not deductible as tax, but can be deducted as interest expense at its full amount. Okay, tax credit. What is a tax credit? A tax credit, it is the right of an income taxpayer to deduct from income tax payable as foreign income tax he has paid to a foreign country subject to certain limitations. I repeat, the tax credit, it is the right of an income taxpayer to deduct from income tax payable the foreign income tax he has paid to a foreign country subject to a certain limitations. Next, tax credit vis-a-vis deduction. I repeat, tax credit versus deductions. Okay, letter A. A tax credit reduces the taxpayer's liability peso per peso compared to a deduction which reduces gross income upon which the tax liability is calculated. Letter B. A tax credit differs from deduction to the extent that the former is subtracted from the tax while the latter is subtracted from the income before the tax is computed. I repeat, For the tax credit versus the deduction, letter A tax credit reduces the taxpayer's liability peso per peso compared to a deduction which reduces gross income upon which the tax liability is calculated. Letter B, a tax credit differs from deduction to the extent that the former is subtracted from the tax while the latter is subtracted from the income before the tax is computed. Okay, next is the taxpayers who may claim tax credit. These are the list of the taxpayers who may claim the tax credit. Number 1, citizens. Number 2, DC or the domestic corporation. Number 3, a member of the GPP or a member of the general professional partnership. Number 4, beneficiary of an estate or tax. I repeat, the taxpayers who may claim the tax credits are number 1, the citizens. Number 2, the domestic corporations. Number 3, a member of the general professional partnership. And number 4, beneficiary of an estate or trust. Okay, let's go to letter D for the itemized deduction, which is the losses actually sustained during the taxable year and not compensated for by insurance or other forms of indemnity. I repeat, these are for the itemized deductions. Letter A, ordinary and necessary expense. Number 2 is the, oh my god, where is number 2? I'm sorry. I repeat, for the itemized deductions, number 1, ordinary and necessary expenses. And then number 2 is the interest expense. Number 3 is the taxes. And now this topic is the number 4, the losses actually sustained during the taxable year and not compensated for by insurance or other forms of indemnity. Okay, requisites for deductibility. Number 1, loss belongs to the taxpayers. Number 2, actually sustained and charged off during the taxable year. Number 3, evidence by a close and completed transactions. Number 4, not compensated by insurance or other forms of indemnity. Number 5, not claimed as deduction for estate tax purposes in case of individual taxpayers. And number 6, must be connected with the taxpayer's trade, business, or profession, or incurred in any transaction or incurred by an individual in any transaction entered into for profit, though not connected with his trade, business, or profession. Number 7, if it is a casualty loss or losses arises from firestorms, shipwrecks, or other casualties, or from robbery, theft, or embezzlement, it is evidenced by the declaration of loss file within 45 days with the BIR. I repeat, for the requisites for deductibility. Number 1, loss belongs to the taxpayers. Number 2, actually sustained and charged off during the taxable year. Number 3, evidence by a record and completed transactions. Number 4, not compensated by insurance or other forms of indemnity. Number 5, not claimed as deduction for estate tax purposes in case of individual taxpayers and must be connected with taxpayers' trade, business, or profession, or incurred in any transaction or incurred by an individual in any transaction engaged or entered into for profit, though not connected with a trade, business, or profession. And number 7, the last, is if it is a casualty loss and it is evidenced by declaration of loss filed within 45 days with the BIR. Next is the non-deductible losses. Non-deductible losses. Number 1, losses in dealing between related taxpayers. Number 2, losses from wash sales of stocks. Number 3, losses due to removal of buildings purchased. And for the next topic is the Marcelo Doctrine. Okay, next topic is the Marcelo Doctrine. A Marcelo Doctrine is a loss in one line of business is not permitted as deduction from gain in another line of business. I repeat, in Marcelo Doctrine, a loss in one line of business is not permitted as deduction from gain in another line of business. Okay, here's the difference. Uh, the differences between losses and rules on deductibility. Okay, losses. One of the losses is number one, ordinary losses. And the rules on deductibility is deductible net of indemnity, which is may be deducted from capital gains. Next, capital losses. In capital losses, the rules on deductibility is it is deductible to the extent of capital gains only. Next, securities becoming worthless. In securities becoming worthless, it is deductible if worthless securities are capital assets, which is exempt where the taxpayer is a bank or trust company, and if it is in non-deductible if worthless securities are ordinary assets. Next, for the losses on wash sales of stock securities, the rules on deductibility is that the general rule, losses from wash sales are not deductible. But here's an exemption. When the taxpayer is a dealer in securities and the transaction from which the loss is resulted was made in the ordinary course of the business of such dealer, the loss is deductible in full. Next is the wagering loss. In wagering losses, it is deductible only to the extent of wagering gains. Next is the NOLCO, or the net operating loss carryover. Now, the rules of deductibility is that it is deductible for the next 3 consecutive years following the year of such loss, but provided that the taxpayer was not exempt from income tax in the year of such net operating loss. And number 2, there has been no substantial change in the ownership of the business of the enterprise. Note, a net operating loss during the first 10 years of the operation shall be allowed as NOLCO, or net operating loss carryover, for the next 5 years in case of mines other than oils and gas wells. Next, for the losses of abandonment losses. In abandonment losses, the rules on deductibility is that when a contract area where petroleum operations are undertaken is partially or wholly abandoned, all accumulated exploration and development expenditures pertaining thereto shall be allowed as a deduction. Next is when the second rule of deductibility is that when a producing well is subsequently abandoned, the unamortized cost thereof, as well as the undepreciated cost of equipment directly used therein, shall be allowed as a deduction in the year of abandonment. Note, if such abandoned well is re-entered and production is resumed, or if such equipment or facility is restored into service, the said costs shall be included as part of gross income in the year of resumption or restoration. Next is the effect of NOLCO. The effect of net operating loss carryover when the corporate taxpayer is subject to MCIT, or the minimum corporate income tax. Okay. The effect is that the running of the 3-year period for the expiry of the NOLCO is not interrupted by the fact that such corporation is subject to MCIT in any taxable year during such 3-year period. However, such corporation cannot enjoy the benefit of NOLCO for as long as it is subject to MCIT in any taxable period, because NOLCO is only deductible against NCIT, not MCIT. I repeat, for the effect of NOLCO when the corporate taxpayer is subject to MCIT, the running of the 3-year period of the expiry of NOLCO is not interrupted by the fact that such corporation is subject to the MCIT in any taxable year during such 3-year period. However, such corporation cannot enjoy the benefit of NOLCO for as long as it is subject to MCIT in any taxable period, because NOLCO is only deductible against NCIT, not MCIT. Next topic is the bad debts. Bad debts. In bad debts, here are the requisites for deductibility of the bad debts. Okay. Number 1, there must be a valid and subsisting debt. Number 2, it must be actually ascertained to be worthless. Number 3, it must be charged off within the year of worthlessness. Number 4, it must be connected with profession, trade, or business. Number 5, must be sustained in a transaction between related taxpayers. I repeat, for the requisites of deductibility of the bad debts. Number 1, there must be a valid and subsisting debt. Number 2, it must be actually ascertained to be worthless. Number 3, it must be charged off within the year of worthlessness. Number 4, it must be connected with profession, trade, or business. Number 5, it must not be sustained in a transaction between related taxpayers. Next is the factors to be considered in determining bad debts. I repeat, the factors to be considered in determining bad debts. Number 1, the debtor has no property or visible income. Number 2, the debtor has been adjudged bankrupt or insolvent. Number 3, there are numerous debtors with small amounts of debts, and further action on the accounts would entail expenses in exceeding the amount sought to be collected. Number 4, the debt can no longer be collected even in the future. And number 5, collateral shares have become worthless. I repeat, for the factors to be considered in determining bad debts. Number 1, the debtor has no property or visible income. Number 2, the debtor has been adjudged bankrupt or insolvent. Number 3, there are numerous debtors with small amounts of debts, and further action on the accounts would entail expenses exceeding the amount sought to be collected. And number 4, the debt can no longer be collected even in the future. Number 5, collateral shares have become worthless. Remember that the Supreme Court decided in the case of RPC versus Commissioner that bad debts expense is only allowed if the taxpayer has exerted diligent efforts to collect bad debts or receivables. Otherwise, the BIR will disallow the same. Next is the tax benefit or recapture rule. I repeat, the tax benefit rule or the recapture rule. This is the recovery of bad debts previously allowed as deductions in the preceding years shall be included as part of the gross income in the year of recovery for the extent of the income tax benefit of said deductions. I repeat, the tax benefit rule or recapture rule is recovery of bad debts previously allowed as deductions in the preceding years shall be included as part of the gross income in the year of recovery to the extent of the income tax benefit of said deductions. Next topic is the depreciation. This is letter F. I repeat, for the itemized deductions. Letter A, ordinary and necessary expenses. Number 2 is that the interest expense. Number 3, the taxes. Number 4 or letter D is the losses actually sustained during the taxable year and not compensated for by insurance or other forms of indemnity. And number 5, the bad debts. And this is depreciation. Letter F, depreciation. Okay, depreciation. It is a reasonable allowance for the exhaustion, wear, and tear of the property used in the trade or business. I repeat, depreciation. This is a reasonable allowance for the exhaustion of wear and tear of the property used in trade or business. Okay, here's the requisites for the deductibility of the depreciation. Number 1, the property depreciated must be used in trade, business, or exercise of profession. Number 2, the property subject to depreciation must be property with life of more than 1 year. Number 3, the depreciation must have been charged off during the taxable year. Number 4, the depreciation method used must be reasonable and consistent. And number 5, a depreciation schedule must be attached to the income tax return. I repeat, for the requisites of the depreciation is that number 1, the property depreciated must be used in trade, business, or exercise of profession. Number 2, the property subject to depreciation must be property with life of more than 1 year. Number 3, the depreciation must have been charged off during the taxable year. Number 4, the depreciation method used must be reasonable and consistent. Number 5, a depreciation schedule should be attached to the income tax return. Next is the options granted to private educational institution. I repeat, options granted to private educational institutions. A private educational institutions may, at its option, elect either letter A to deduct expenditures otherwise considered as capital outlays of depreciable uh, assets incurred during the taxable year for the expansion of school facilities. Letter B, to deduct allowance for depreciation. I repeat, for the options granted to private educational institutions is that a private educational institution may, at its option, either elect number 1, the deduct expenditures otherwise considered as capital outlays of of depreciable assets incurred during the taxable year for the expansion of the school facilities, or letter B, to deduct allowable for to deduct rather to deduct the allowance for depreciation. Next is the depreciable assets. Number 1 in depreciable assets is the tangible property used in trade or business. Number 2, intangible property like patent, copyrights, and franchises. Next is the depreciation expense for NRAETB or RFC. I repeat, depreciation expense for non-resident alien engaged in trade or business or the resident foreign corporations. Okay, the reasonable allowance for the deterioration of the property arising out of its use or employment or its non-use is the business, trade, or profession shall be permitted only when such property is located in the Philippines. Okay, next is the depletion of oil and gas wells and mines. This is letter J of the itemized deduction. Depletion of oil and gas wells and mines. Okay, in the reasonable allowance for the exhaustion of natural resources like mines, oils, and gas wells as a result of production or severance from such mines or wells. I repeat, for the depletion of oil and gas wells and mines, it is reasonable allowance for the exhaustion of natural resources like mines and oils and gas wells as a result of production or severance from such mines or wells. Now, for the requisites for the deductibility, there must be a depletable asset. And number two, the allowance for depletion must be charged off within the taxable year. And number three, it must be computed based on cost depletion, and that the depletion expense for an NRA ETB or RFC is that the oil and gas wells or mines must be located within the Philippines. Okay, next topic is the charitable and other contributions. Charitable and other contributions, here's the requisites for deductibility. Number one, it must be actually paid during the taxable year. Number two, must be given to the organization specified by the tax code or special law. Number three, the net income of the institution must not inure to the benefit of any member or individual. Next is the contribution deductible in full of the charitable and other contributions. I repeat, contributions deductible in full. So full deductions. Okay. Number one, donations to the government of the Philippines or political subdivisions, including fully owned government corporation, to be used exclusively in undertaking priority activities in number one, culture, number two, health, number three, economic development education, number four, science, number five, human settlement, number six, youth and sports development. I repeat, for the contributions deductible in full, number one, donations to the government of the Philippines or political subdivisions, including fully owned government corporations, to be used exclusively in undertaking priority activities in number one, culture, number two, health, economic, number three, economic development education, number four, science, number five, human settlement, number six, youth and sports development. Okay, next of the contributions donations in full is that number two, donations to foreign institutions and international organizations in compliance with treaties and agreements with the government. I repeat, for the number two, donations to foreign institutions and international organizations in compliance with treaties and agreements with the government. Next is the number three, donations to accredited NGO. Letter A, exclusively for cultural, charitable, health, educational, scientific, social welfare, character building, and youth and sports development, research, any combination of the above. Alright, next is the donation must be utilized not later than the 15th day of the third month following the close of taxable year. And next is the administrative expense must not exceed 30% of the total expense. And next is the upon dissolution, assets shall be transferred to another non-profit domestic corporation or to the states. And last is the number four, donations of prizes and awards to athletes. But here's a limitation for the donations of prizes and awards to the athletes. Number one, for the individuals, is that deductible contribution shall not exceed 10% of taxable income before contributions. There be for corporations is that deductible contributions shall not exceed 5% of the taxable income before contributions. I repeat, these are the limitations, is that for individuals, it is deductible contribution shall not exceed 10% of the taxable income before contributions. And letter B, for corporations is that deductible contribution shall not exceed 5% of the taxable income before contributions. Note that contributions to the candidate in an election is not an allowable deduction because the said expense is not directly attributable to the development, management, and operation and or conduct of business or trade or profession. Next is for the next category of the itemized deduction is the research and development. Research and development. Okay. I'll be reading only until the last number of the itemized deduction. Uh, Last is the pension trust contributions, and then there will be part 4 for the reading of this UST taxation review. Okay, this is second topic from the last. Okay, this is letter I, research and development. The taxpayer may either treat it as a revenue expenditure. Revenue expenditure, it will be wholly deducted as ordinary and necessary expense in the year it is paid or incurred. Number 2, deferred expense. In deferred expense, it is allowed as deduction ratably distributed over a period of the least 60 months starting from the month benefits are received from such expenditures. And for the last topic is the letter J. It is the pension trust contributions. Pension trust contributions. Pension trust contributions, it is applicable only to the employer on account of its contribution to a private pension plan for the benefit of its employees. Here's the requisites for deductibility. Number 1, the employer must have established a pension or retirement plan to provide for the payment of reasonable pension to his employees. Number 2, it must be funded by the employer. Number 3, the pension plan is reasonable and actually sound. Number 4, the deductions is apportioned in equal parts over a period of 10 consecutive years beginning with the year in which the transfer or payment is made. Number 5, the payment has not yet been allowed as deductions. Number 6, the amount contributed must no longer be subject to the control and disposition of the employer. I repeat, for the pension trust contributions is that requisites for deductibility is that number 1, the employer must have established a pension or retirement plan to provide for the payment of the reasonable pensions to his employees. Number 2, it must be funded by the employer, and the pension, number 3, and the pension plan is reasonable and actually sound. And number 4, the deduction is apportioned in equal parts over a period of 10 consecutive years beginning with the year in which the transfer or payment is made. Number 5, the payment has not yet been allowed as a deduction. And number 6, the amount contributed must no longer be subject to the control and dispossession of the employer. Next is the income from pension plan. Income from pension plan. Number 1, it is not taxable to the employees. Number 2, if a portion of the funds is reverted back to the employer, said fund forms part of the income of the employer during the taxable year of the reversion. Next is the deductible payment to pension trust. Deductible payments to pension trust. Number 1, employer's current liability. Number 2, employer's liability for past services. Okay, let's go to number 1, employer's credit liability. Employer's current liability. I repeat, for the deductible payment to pension trust, number 1, employer's current liability, and number 2, employer's liability for past services. Okay, let's go to number 1, employer's current liability. Amount contributed during the taxable year shall be treated as an ordinary and necessary expense. Letter B, or number 2, employer's liability for past services. It is 1 1/10 of the reasonable amount paid to cover expenses, liability applicable to the preceding 10 years. And that the basic rule on allowable deductions is that the capital expenditures are not deductible but must be amortized over a reasonable period of time, except these new deductions, research and development expenditures. In one case of the Supreme Court said, these expenses to protect brand franchise are in the nature of capital expenditure, like advertising expenses to stimulate future sale of goods and services. And that's the end of our um, part 3. I'll be back for the part 4 of our taxation law. So that's all for today.
Thank you so much for listening. I do hope I contributed something to help your taxation law review for the Philippine Bar exam. If I do, please hit the like and subscribe button. Thank you so much, and God bless everyone.